Welcome back. You're watching Stock Watch. With me is Nader, and joining me to unpack your stock-related questions tonight are Mark Du Toit from Oyster Investments and Nader from Benguela Global Fund Managers. Please be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. Pretty red screens across the board, but actually we started to see as the markets, after our market closed, that the US markets are kind of trying to climb back into green territory. And I'm wondering, there seems to be a dramatic shift, Mark, after the US inflation print that came out yesterday. Do you think that it is valid, it is justified, considering that inflation only ticked up, was 0.1% higher than what markets had anticipated? Or are markets just worried about the fact that it seems to be drifting further and further away from the 2% target that the Fed has penciled in?
Yeah, so I think that definitely the inflation data that came out was a disappointment for the market. I mean, the market has been pricing in quite aggressive rate cuts at the start of this year. And as the years progressed, inflation hasn't come down as expected. And so the rate cuts are getting pushed out further and further. I mean, so the high interest rates obviously is a headwind for economic growth. And if they're pushed out further, it's more difficult for people to make money. So I guess that, until we see some decent headway made on the inflation front, I think markets are going to be a bit more worried about it.
Yeah. Grant, are markets maybe not a little bit too dramatic by shifting the can forward, kicking the can forward further down the year from June to now September in terms of when we can expect the Fed to cut interest rates?
Yeah, I think markets are very emotional and have been, as Mark said, since the start of the year. I mean, they were looking for 7 cuts at one point. It's ridiculous. I think realistically, whether they cut in June or September, fundamentally or economically, isn't actually going to make much difference. And if it's 2 cuts or 3, it's also not going to make a difference. It's really what's going to drive things is the sentiment shift, the start of the cutting cycle. And the fact is, if we step back and look at the market, the US economy in particular is actually very strong. Companies' earnings are forecast to grow this year. And that's within this high rate environment. So I suspect we're closer to normal rates than people think. And then, of course, there was a bit more encouragement. If you look at the ECB this afternoon, they reaffirmed their view to cut rates in June. So that's the second major central bank potentially cutting that will follow. And so there's China, of course, had low inflation numbers, so they're going to export deflation if they carry on in that trajectory. So yes, the US economy is driven by this high services inflation, but that's also because there's a lot of strength in the consumer. So I don't think it's as doom and gloom as the reaction suggests. Yes, the rates have gone out. That doesn't help. It's probably worse for South Africa than it is for the US market, to be honest, because our economy needs it more.
Yeah, of course. Well, let's get straight into the questions from our viewers. Starting off with Sasol, always quite an interesting one there to get analysis from our market analysts. What is your view on Sasol? I bought at 172. Of course, now it's at around 164, 165. Should I hold, and what price should I sell it? I guess that's really always the question. Should I hold or dump the stock? And if I'm dumping it, when should I actually dump it? Mark, firstly, your future view on Sasol.
So Sasol, has historically been a very geared play to the Rand oil price. And then they made their big offshore investment in Lake Charles and built a big chemicals plant in Lake Charles. So now the business is more balanced in that it's geared to the Rand oil price, but also to chemical prices in the US. And that's been a real headwind for them. And I think that until we see chemical prices start to move up, I think it's going to be difficult for the Sasol share price to really go higher, because they've got a lot of US debt and they need earnings from their cracker in the US to pay down that debt. And at the moment, there's just not enough earnings coming out of the out of the US operation to really make a meaningful impact on it. So I think for now, Sasol's actually in a bit of a stuck position, but things can change quickly. And if the oil price goes higher for any reason, like if there's more unrest or any kind of supply shocks, you know, then Sasol's share price can go up. So it's a very difficult one to call because of its gearing to the commodity prices.
Yeah, things can really change quickly because I think, what was it, late 2022 or early 2023, there were price targets on Sasol for about 500. Grant, at this point, considering how volatile everything has been, but of course, also looking at Sasol's correlation to the oil price, and actually now we have actually started to see the share price responding to the higher oil prices that we have been seeing. So the viewer bought at 172. Should they hold? And if they sell, should they sell now? Obviously, they'd be making a loss. When do they sell at this point? Should they wait for it to go higher?
Yeah, I mean, it's a good question. So I think, first of all, Sasol is not a high-quality business. They're struggling operationally. They're struggling with many things. But if we set that aside and we say, well, if you're buying, the viewers buying it because they think oil prices run and there's some upside, perhaps it's a trade, I think that's fine. I think oil's up about more than 10% this year. The rand has only strengthened 1% or 2%. So we're actually getting that improvement in earnings just as things stand. Less gear than it used to be, but it is still there. Sasol's trading very cheap. I think it's trading on 4 times earnings. So there's quite a lot of that bad news and challenges and all those various things in the price already. So I would say, by all means, have a go, but bear in mind, I don't think this is a buy and hold long term. I think you buy it in your mind, you say, well, this is how much I'm prepared to lose. This is where I'm going to get out, and say I'm wrong. I think there is a trade to be had, but just be aware that I don't think it's an investment. I think it's a trade. If it was me. And I would also say, look at the oil. The prospects for oil actually look pretty strong. The Middle East tensions are only rising. They're not really falling. That is traditionally very good for oil if there's a supply disruption or something along those lines. So I think there's enough reasons to say it's worth a go, but I would define my entry and exit levels quite clearly because it's not a long-term investment. Don't put it under your pillow and forget about it. That's what I would say.
Yeah, so not for orphans and widows. Mark, yeah, would you be trading this, or would you be looking at it from a long-term investment kind of landscape? And also, if the future is too uncertain at this point, do you just cut your losses now, or do you kind of hold on and wait for it to get higher for you to at least get something out of it?
Yeah, I think you have to look at your investment landscape, and for us, we're not very bullish on Sasol at the moment, so we would look to rather move our money into something else, which we thought had better prospects of returns. So unless you have a very strong view on the chemical prices going up, then yes, I would sell it and rather put it into something else.
All right, I hear you on that. Well, let's talk about some of the big news for today. Of course, we did have the We Buy Cars listing on the JSE, one of the first listings on the JSE for 2024. Very interesting question. How do you get an 18 Rand share out of a 9 Rand share? Please help make sense of it. Of course, the last time I checked, I think it closed over 20 Rand a share. Grant, just, talk to us about the mechanics of this and kind of, I guess, the value unlock of it.
Yeah, I think the 20 Rand share of an 9 Rand share, it's a funny one. But it's obviously a function of the number of shares that are in trade as well. So the existing market cap is now about 8.5 billion. That value has been given to the shareholders. So they always had that value, but it was clouded by all this heavy. I mean, I think Transaction Capital's debt, or SA Taxi's debt, is north of 15 billion. So those challenges, that debt burden, it wasn't clear what the obligation for We Buy Cars is in terms of leaning on them for any ultimate debt call down. So it was very clouded and very noisy in there, and I think this deal has really allowed them to step away, break any future claims. And they paid for it, but there are no longer any claims in relation to debt associated with Transaction Capital So it's a clean business. That value was always there. It was always in the shareholders' hands. They didn't raise 8 billion of cash. They issued the shares to the shareholders, which are worth 8 billion. Plus you add transaction capital, and then you'd have to take the debt in there into account. And the collective is still the same value, plus perhaps a little bit of unlock.
Well, I mean, just looking at what has happened, of course, the initial IPO price was 18 Rand 75, Mark. It did trade above 20 Rand. What is your reading of how it traded today and how investors responded to it?
Yeah, I mean, you always want your share price to go up on the day that you list. So I would say it's a successful listing. And we also think that there's further value in We Buy Cars. We like the business. We like the growth prospects, certainly in the next 2 years. And if the economic activity picks up, it'll be even better. And so, yeah, I think you can still buy We Buy Cars at 21 Rand even.
All right. And actually just, looking at We Buy Cars I don't know, would you say that it doesn't really have a rival? For example, if you look at your other car counters like Motus, Grant, how are you looking at, the competitive landscape for We Buy Cars, or it just does not have a rival exactly on the same level?
Yeah, I mean, it's a good question. I don't think the key rivals are the Motuses of the world, but there's actually quite a competitive landscape online. So I think it's car.co.
Yes.
Well, there's a number of online sellers, and of course your barriers to entry are not that high. You just need to be able to provide the infrastructure of the website. But what We Buy Cars has done to build some kind of moat is build these massive warehouses and viewing spaces like the Dome and they've got these sort of key centers. So they're building a moat, and I think they are definitely the leader in the space. But I think it's more competitive than it appears at first glance, is what I am saying. But that doesn't mean I think they're under threat from these other competitive forces. We don't happen to hold this one, but I do think it's a good business, and I think there are positive prospects in this one as well.
All right. Mark, of course, some more questions coming in from the viewers. Let's go to City Lodge. Are you bullish on City Lodge? Its share movement has an interesting history. In October 2020, it was valued at 2.50 Rand. In October 2021, it was 5.40 Rand. And of course, pre-rights issue, it was high 20s. And since then, it's just bounced between 4 and 5 Rand. What will it take for it to climb in price? Let's actually, before we actually go into what will it take for it to climb, I mean, just that divergence, from high 20s to 4-5 Rand, did this significantly change the fundamentals of the stock, Mark?
So they did a rights issue, so they had to issue more shares and raise capital, and that would be the main reason for. So before your share was worth 20 Rand per share, now you've got more shares in issue. Now the same business is worth 5 Rand per share, so that would be the main reason for the price coming down on a per share basis. I think for City Lodge, I mean, they have good assets, but they are very geared to the South African economy. So when you own a hotel, you have high fixed cost base, and you have a sort of an 80% capacity that you can run at consistently. And if the economy's going well and people are traveling, there's a lot of business travel, and your capacity goes up and you make a lot of money because your costs stay largely the same. So I think for City Lodge, I mean, for you to be bullish on their prospects, you'd have to be bullish on the South African economy growing faster. And certainly if interest rates come down, I mean, that is something that we will see. So again, we're kind of in this position where we're waiting on the US interest rate cuts, because South Africa can't cut its interest rates without US bringing their interest rates down. Our currency will just be the balancing factor there, and our currency will weaken. So we need US interest rates to come down, we need inflation in the US to come down, and then the South African economy can open up a bit, and we'll be bullish for stocks like City Lodge in particular.
All right. Grant, welcome back. We're talking about City Lodge. The question is, are you bullish on City Lodge? And of course, the viewer goes on to detail the share price history, how it was high 20s pre-rights issue. In October 2020, it was R2.50. October 2021, R5.40. And of course, how now it's been bouncing between 4 and 5%. Asking really, what will it take for it to climb in price? Mark has already detailed some things, including how highly geared to the economy it is, that you need the economy to start doing better, and also interest rates to come down. Any additional thoughts on what it would take for that share price to climb up? But also another interesting question here from the viewer: is bigger institutional investment necessary?
I think Mark hit the nail on the head. It needs an economic recovery. There's very little they can do on their own. They've still got quite a bit of debt they have to work their way through. And they're also quite vulnerable to the likes of the Airbnbs and those kind of alternate accommodation competitors, because they don't have that unique position of the more upmarket hotels, etc. So I think it's a tough one. It's got a tough outlook, and it ultimately needs the macro outlook to improve.
Yeah.
The economy to improve its fortunes materially from here.
Is it also, Grant, just sticking with you, worth looking at kind of the structure of the investment base of City Lodge at this point? Like the viewer asked, do you think that more institutional investment is needed? What is the appetite of institutional investors for City Lodge?
So the appetite of institutions is always a function of the market cap and the liquidity. So, well, ultimately the liquidity, not even the market cap. This is a 2.5 billion rand company. So if you're an institution, it's very difficult to even buy a meaningful stake. And if you can't buy a meaningful stake, even if you're right in buying it, it doesn't make any money for you in your portfolio. So it doesn't move the needle in terms of your returns. So unless you're a dedicated small cap fund, this kind of stock tends to be outside the realm of what you could play in, even if you wanted to. It doesn't make sense, unfortunately. So you need significant improvement in fortunes, or perhaps someone doing a buyout if it gets cheap enough, or something to drive a change in the shareholder dynamic, I would think.
All right. Well, let's get to another question here. Signia Group. How does your panel of experts feel about Signia as a holding company? Are they bullish on the company? I think this is one that not a lot of people actually ask about. Instead, they'll ask about the ETFs. Mark, what do you make of Signia?
Yeah, so an asset management business. So what you really need to grow earnings is you need flows. You need more people to invest in your products. Or the other, if the market goes up a lot because you charge fees based on the size of the fund. So if your fund goes up a lot because the market's gone up, then also your earnings grow. So yeah, I mean, I think that in order to buy Signia, you'd probably have to be quite bullish on those two factors, AUM flows and market performance. I think, again, in this space, I mean, we would prefer the larger cap player, which is N91. I think that N91's got more growth prospects in the AUM gathering space. They've got a bigger distribution network. So for me, I'd choose N91 over Signia, but similar drivers to the business.
All right. On your side, Grant, I mean, is this one that you'd be looking at, or maybe not that bullish on?
I think Signia has actually done quite a good job in this market. They've grown AUM quite meaningfully from nothing 10 years ago. They've done a very good job there. Also, a lot of assets administration. I think it's at 150 odd billion, if not more than that. I don't have the numbers offhand.
Yeah.
So it's a good little business. I guess the difference with 91 is that this is a passive strategy. So there's naturally more money flowing toward passive strategies at this point in time. But it is also highly competitive, and the margins are tight. So you've got the likes of the BlackRocks and the iShares coming into SA offering similar products. So now their actual their differentiator is getting a lot smaller and is a lot more difficult to stand out. So I'm not sure how well they're going to operate over the next few years, given how competitive and how many other choices investors now have among some of these global competitors. So I also like 91. I think it's a quality business. And of course, with that, you also get a nice offshore exposure. They're about 50% of their money, their funds under management sits in the UK and a little bit in the US. So all
right. Well, talking about standouts, something that stood out for me today was Sibanye-Stillwater, that share price down over 3%, I think even almost 4% at some point, while the rest of the PGM stocks were actually trading in the green. We did see Northam and Implats leading the gains there. And Mark, I'm wondering why, and if you can peg it to the retrenchment or another round of retrenchment talks that they're having there on their gold operations, or was it maybe something else?
Yeah, I mean, I've been surprised at how well Sibanye has traded up until this point this year. The PGM prices are still where they were at the start of the year. So, I mean, they had a rally in December, but since then the PGM prices haven't gone up much more. But the PGM mining stocks have really gone up quite a lot, so up more than 20% in the last month. And I think now with Sibanye's announcement today, it highlighted, the difficulty that these mining stocks are having at the moment. And what's even more of a worry, I suppose, is that the retrenchment announcement is in their gold space. So Beatrix is their gold mine. And even at these high gold prices, if you still can't make the gold mine profitable and you have to announce a retrenchment and a shutdown, I think the market's going to start to worry a little bit about what the production outlook looks like in the more medium term. And so, you highlighted the difference between Sibanye and Implats. I mean, it could be people who are selling the Sibanye and then buying Implats to move their exposure between the two and, keep an overall sector exposure to the PGM space.
Yeah. It's really quite interesting because there was a point when Sibanye was really a favorite. And I mean, even when I was looking at this announcement, I thought that they were announcing another round of retrenchments in the PGM space. But now, as Mark points out, that it's in the gold operations, even though the price of gold is at all-time highs. Grant, and of course, Sibanye also seemed to be one of the cheap ones to go into. What would you make? Do you think that, there is a shift in terms of investor sentiment for Sibanye at this point?
I mean, there might be a shift in sentiment. Ultimately, it's going to follow the PGM sentiment. I will note that Sibanye has the worst balance sheet. They have the most risk in terms of the capex they outlay they need to make, and in terms of the operational costs that they have, especially with the palladium, the Stillwater in the US. So it's not our choice. We don't own Sibanye. If I was going to take a view on the space, we would rather pick one of the other PGM miners that have a little more of cash flow. They've got a much better balance sheet, and you can feel a little more comfortable that they're not going to be under pressure if the price drops another 10%, for example, and they're not sort of question marks around another raising. I mean, remember Sibanye recently had to issue those convertible debt, and so I think. Also, I don't like the strategy of the acquisitions are very aggressive and at probably a very challenging time in the company's life cycle. So yeah, I would stay away from Sibanye, but I wouldn't. You can play in the space potentially for a recovery from here, but it wouldn't be through Sibanye in my view.
Well, Grant, what are you not staying away from today? Your stock pick?
So I've gone with TSMC, which is the Taiwan Semiconductor. It is the preeminent semiconductor manufacturer. And I guess there's two drivers here. One is just on the general semiconductor level, there's the inventory cycle is turning. We're at inventory lows and normalized levels across the supply chain. And we see that cycle having bottomed and improving. And then if you add to that, they're at the cutting edge and the bleeding edge of semiconductors. So for example, NVIDIA has tied up all of their production at that top end for the next 2 years because they are the only ones who can really operate at that level at this point in time. So I think you've got that, you're tapping into some of that sort of AI rollout that's taking place, that infrastructure rollout. And then at the same time, the fundamentals of the broader industry and the business are also improving and turning from here. So I think there's 18 to 24 months of improving earnings on the table for this one.
Yeah, all right.
That's my pick.
All right. Mark, on your side, where are you seeing an edge?
Yes, so I'm picking Process tonight, principally for its exposure to Tencent, which is its biggest asset. Tencent's about 90% of the net asset value of Process. And we like the prospects. Tencent's recent earnings announcement was very positive. Operating profits up 26% year on year. We think that they can continue to grow earnings above 20%. I also think that, the US tech stocks have kind of been the only game in town for the last 10 years. And I think that if we see kind of earnings starting to slow a little bit in the US, people are going to look to reallocate some of their portfolio, and maybe you want to own a cheaper tech stock, and Tencent is, stands out. It's derated, and they're trading at quite a wide valuation gap to the US tech stock. So I think they're at the bottom, and I think that a shareholding in Prosus will do well from these levels.
All right. Well, thank you so much for your time and for your analysis today, gents. Much, much appreciated. That is all for tonight's Stock Watch. Thanks to our guests, Mark Du Toit from Oyster Investments and Grant Nader from Benguela Global Fund Managers. Up next, The Close. Stay with us.
Thank you.